Okay, let's begin. Good morning, ladies and gentlemen. Thank you very much for joining us. I'm Rajesh Merchandani, the Senior Director of Communication and Policy Outreach here at the Centre for Global Development, and I'm very pleased to see so many of you here this morning and to welcome our committee members. The Latin American Shadow Regulatory Committee, or CLAF, to give it its Spanish acronym, has been gathering twice a year, I think, for some 10 years or more, to examine trends in Latin American economies, to address weaknesses and challenges, and to make recommendations to financial regulators about what to do. This year, a number of factors leave Latin America at a crossroads, either heading back to the dark days of the 1980s that were plagued by successive crises in emerging markets, or perhaps able to weather the stormy conditions and rebound. And that's the theme of this year's report from the committee. Its 34th report, in fact. A little about the committee. You can't apply to join. You must be invited, which means you must be a leading thinker or practitioner in the field of Latin American economics and financial policy. And the expertise in this room amongst the committee members is overwhelming. The 10 committee members wear multiple hats, and they comprise 4 former ministers, 3 former chief economists, 3 current directors of programs, 1 former commissioner, and 7 professors. So ignore them at your peril, is what I take away from that. Liliana Rojas Suarez will be familiar to some of you here. She's a senior fellow here at the Center for Global Development and president of the committee. And we'll hear a little bit about her, about the conditions facing Latin America and what then the recommendations are of the committee. And then we'll ask some questions to other committee members on the stage, ask them to consider some issues. We only have half of the committee on the stage purely for space reasons. The others join us here in the front row. So for the moment, let me introduce the ones on stage that are here. Professor Carmen Reinhardt, who's the Professor of the International Financial System at the John F. Kennedy School of Government at Harvard University. Professor Guillermo Calvo, who's Professor of Columbia University and the former Chief Economist of the Inter-American Development Bank. Pablo Giudotti, who from Torquato di Tella University, a professor there, former Vice Minister of Finance from Argentina. And Professor Guillermo Perry, University of the Andes, a non-resident fellow here at CGD, and the former Minister of Finance from Colombia. The other committee members I'll introduce to you in a few minutes' time, and we'll also give them a chance to weigh in as well in the discussion before we invite you all to take part too. So with that, Liliana, let me ask you to take the podium. Give us the details of this year's committee report and the recommendations that you're making.
Hi all, and thank you for being here. My first thing to tell all of you is that we have a new member, Enrique Mendoza, from representing, well, kind of. He's from a Mexican professor at Penn right now, and he will be properly introduced by Rajesh in a few minutes. Well, this year, what we wondered is the following. During the 80s and also the 90s, we can characterize those periods as crisis periods in Latin America that spread throughout the region. And so with current problems facing the region and in such a cumbersome international environment, will that situation be repeated again? Is Latin America going back to the 80s or not? To answer and assess that question, we basically first analyze what has been similarities or difference in the external environment with the 80s, now relative to the 80s. We know that in the 80s, decline in commodity prices were also a factor leading to crisis. And we also have decline in commodity prices, sharp decline in commodity prices now. However, relative to the 80s and the 90s, large hikes in international interest rates were a central role in Latin American financial crisis. This time around, the sources of external financial contagion are significantly more complex. For starters, yes, the US Fed increase interest rate will happen. But the committee believed that the increase is going to be small and in modest increases as opposed to a huge, big hike. However, the committee also believed that even a little increase in interest rate might have significant consequences on increase, basically risk premiums across the region, Why is that? Because investors rebalance their portfolios, their yield, the assessment of yield and risk portfolios, and therefore there will be a reallocation of demand for assets from emerging markets toward towards those producing advanced economies. Second, short-time capital flow volatility has increased significantly, and that has complicated the risk management for banks. We know that there is no full-fledged banking crisis in the region. However, what we have started to see is significant deterioration, not only in non-performing loans in some countries, particularly Brazil, but also numerous downgrades, in credit rating downgrades. Actually, I read that, I believe it was yesterday, Bancul, bank in Mexico, was downgraded too. That's the first one there, but Brazil and Peruvian banks have been downgraded. Third, in the 80s, the international source of funding, and in the 90s too, basically come from one common lender, which was advanced economies, and the US in particularly, the US. Well, now, some countries in particular, more than others, like Venezuela, Ecuador, Argentina, that do not have access to international capital markets, their main source of finance is China. We have that both common lenders this time around, being both the United States and China, as lenders, are retrenching from the region, both in terms of foreign direct investment, portfolio flows. So the shock now is certainly much more complex. Also, the potential channels of contagion from China are multiple. Not only the countries, China's slowdown negatively affects the region in terms of trade, but there is also large uncertainty about what is the real indebtedness of Latin America to China. There is no transparency there to know what is the real situation. And talking about uncertainty and lack of transparency, another element that in the international environment that is critical and a kind of a novel factor is the widespread of shadow banking, which is now, you hear about shadow banking all around, not only in advanced economies, but in emerging markets too. And what about net reserve positions of the central banks? Now there is a spread usage of swaps lines between central banks. Well, on the one hand, yes, you could be increasing your asset position, but on the other hand, you could be also increasing your liability position. What we really need to know is what is the net asset reserve position of central banks. And there is no complete transparency, and in many countries, there is total lack of transparency about the net risk positions. So one of the major recommendations of the committee is to actually that creditor and debtor governments take strong steps to better quantify the level and composition, both at the sectoral and national levels, of liabilities and contingencies. Also, the committee would like to see the central banks step up their transparency as regard to their reserve positions, which otherwise we cannot get a full assessment. Now, going to the region, the region has clearly made a number of progress to deal with crisis and to deal with shocks. One commonly cited is the move toward flexible exchange rate systems, right? And they were absent in both the 80s and the 19th crisis. And this time around, indeed, they are being important shock absorbers to external shocks. But the committee wants to emphasize a number of caveats about this. First, the significant cumulative exchange rate depreciation could actually rekindle the path-through from exchange rates to inflation, fueling inflationary expectations. Well, if that gets out of control, that could potentially jeopardize central banks' credibility. But this is much worse if you have a strong fiscal problem. Because in that situation, without well-anchored low inflation expectations, domestic interest rates would increase, leading to a vicious circle of debt and sustainability, in a situation when you have a fiscal position, highly deficitary fiscal position, and large debt, being it domestic or external, increases, and the case of Brazil comes as a case in point, and I'll talk about that in the next couple of minutes. Well, what basically happens is that increases in interest rates to fight inflation are actually going to make your fiscal stance even worse because of the interest payments that you have to make at higher interest rates. As I was telling you, Brazil is a case in point, and we believe that the resolution to Brazil's problem is central to facilitate Latin American economic growth recovery. Brazil's growing fiscal problem, as you know, has increased significantly since the 2008 crisis, since the Lehman crisis. Given that fiscal situation that has been deteriorating continuously, the monetary authorities in that country relied on continuous increases in interest rates as a means to anchor inflations and inflationary expectations. But Brazil has a large stock of domestic debt. And in that context, increases in interest rate, as I just mentioned, just worsens the fiscal stance. So debt sustainability is actually a serious threat in Brazil. As a financial crisis in Brazil, were it to materialize, have the potential of severe contagion to the rest of the region through a number of links. Direct trade links, well, of course, Mercosur countries come to mind as first candidates, but also as well through financial channels. Why? Because Brazil is an important part of the investment in portfolios in the international capital markets. Brazil is a very liquid country. What does it mean? That means that if I have a problem in one country and I want to get rid of that asset issued by that country, I am an investor, and I want to get out of an asset issued by a given country. High liquidity means that you can buy and sell quickly. So Brazil being a high liquid country, the reason that many people have gone in is because they have the expectation that they have gone out quickly. And that high liquidity is also shared by other countries in the region, including Mexico. So if I cannot sell as much as I want from my portfolio investment in Brazil, I can also sell Mexico, but I can also sell Turkey, another emerging market that is highly liquid in the region, or the other way around. If I want to sell Turkey, I can sell Mexico or Brazil. So the forces of financial contagion are large if a problem in Brazil deteriorates. So containing a potential sharp deterioration in Brazil's economy is terribly important for the region to answer the question in our statement, but it's also particularly important for Argentina prospects. We'll have more some questions that will go directly to the Argentinian case, but Argentina is right now kind of in a threshold. There is going to be, next week, elections, a change in government, and a new government, whoever that government is, will be facing very complex, homemade financial difficulties. Problems in Brazil will only complicate even more the potential for solving the problems in Argentina, given the connections between these countries. Now, when a country loses its anchor, its fiscal anchor, and its monetary anchor, usually it goes to the IMF. We believe as a committee that the international community in general and the IMF in particular should start ready to support adjustments in Brazil. not only because the support will help Brazil, but also, again, to regain its fiscal anchor and credibility of the monetary policy, but also to contain contagion to the rest of the region. The answer that we pose in the question to our statement depends on this support. Okay, I hope I made 10 minutes.
Thank you very much, Liliana. Let's bring in some of the other panelists on this. Actually, Liliana, let me ask you a question first.
No, siempre.
We're going to start with you.
Oh.
We're going to answer your question. Pay attention, there's people watching. Your statement, the report emphasizes that this potential for contagion, that's in America, especially from other markets like Brazil. But tell us a little bit about how that would take place. Is there something different about that process this time? I'm specifically thinking about previous examples, the Russian crisis or what's called the tequila crisis. Let's start with that point.
So,
you can't hear me? Is that better? Am I on? Okay, I'll just speak up for the moment.
There is a microphone here, just in case, huh?
No, it's fine. Fine.
Okay.
So I asked Liliana to explain a little bit more about the process of contagion. How might it take place if it were to take place? Liliana.
Yes, very quickly. In the 80s, as you know, part of the resolution of the crisis in Latin America was through the issues of the so-called Brady bonds that largely implied the introduction of Latin America into the international capital markets. The debt crisis of the 80s was in the context of a relationship of credit from international banks to the basically governments in the region. And so when you have a relationship between banks, international banks, and the sovereigns, the governments, then there is large scope for negotiation. It's not internationally traded. The move towards the Brady bonds implied that now the bonds are negotiated in international capital markets and open the door to actually being subject, for the region being subject to the vagaries of the international capital markets. That was reflected in the tequila crisis and in the effects of the Russian crisis on many emerging markets, including Latin America. Now we are, and that actually gave rise, because of those crises, gave rise to Latin America. This realized that without a number of changes in their system, they were not going to be able to deal with these vagaries of the international capital markets. However, and they moved to flexible exchange rates, and they did some reforms on the banking system, and some of them adjusted fiscal, and some of those did not. However, as I mentioned, for this system to work, there is a number of other conditions that need to be met, especially good, sound fiscal positions. And another something else that did not happen was that the region remained very low in terms of saving ratios. So the conditions right now are really more complex than they were in the past. And therefore, because of the factors that I just mentioned, include all these relationships, so transparency with shadow bankings, the China positions, and all that, implies that the sources of contagion through international capital markets have been getting more and more complex as we move from the 80s to the 90s to now. The nutshell of all this is that investors basically have a portfolio. The more rich is their portfolio, the more liquid it is, the easier it is also to move from one asset class to another asset class. And the financial contagion is very strong. So you wanted to add something?
No, just to add, if the chairman allows me.
Go ahead.
Just add a footnote to what you said.
Mm-hmm.
And that is, we've been going through a period with very low interest rates. And so there's been a search for yield And the concern is that that search for yield was looking also for liquidity. So given the threat of a possible rise in U.S. interest rates on highly liquid assets like treasury bills and bonds, that could provoke a massive fly to quality that would not distinguish very well between different borrowers. So something that happens in Brazil, which is so big and so central for many of these countries that trade with Brazil, particularly the Mercosur countries, that could trigger a fly from to quality that has very costly implications for the region. You can call it contagion.
Okay, Guillermo Calvo, thank you very much. Pablo Giudotti, why don't you come in on this point?
No, I think that it's worth taking into account that Brazil traditionally has been a country that has relied a lot on short-term debt, and therefore has traditionally had a very high, very large borrowing requirements. Okay, even today, after having improved its situation, Brazil continues to have one of the largest borrowing requirements as percent of GDP in the emerging market world. Okay, and so this is which is close to 20% of GDP, which is a big number compared to many countries, even today advanced economies. So that I think is a consideration that needs to be taken seriously into account as a source of potential contagion.
Professor Giudotti, while I have you, you are the former Vice Minister of Finance in Argentina. Let's think about the elections, the presidential elections. What kind of difference are we going to see in Argentina, do you think, after the elections?
Well, what appears from the polls is that the opposition candidate is going to win the election this Sunday. And that would represent a major change in Argentine politics, as this party or coalition that would be winning this time has never really been empowered and and comes from a portion of the political spectrum that is different from the traditional parties in Argentina. At the same time, it is clear that the cocktail that inherits any future governments is very complex and poses formidable challenges. We have mentioned a number of elements, like a large fiscal deficit in the order of 7% of GDP, a high inflation, a widespread exchange and capital controls. We have an unresolved legal issue as regards the external debt in New York, which makes the country really makes it very difficult for the country to access international capital markets. So certainly there is the need for a comprehensive economic program, which I would say would have to be implemented or as soon as the government takes charge, the new government. In addition, we'll have a transition between the 23rd, next Monday, and the 10th of December. That is the date where the new government takes office. That actually will pose a very complicated period in which expectations will start to play a role while still the new policies or the new government is not there. I think that the situation is going to be, it will need a very careful management of the economy. But if Argentina is successful, I think that Argentina may return to be a sort of a bright spot in the region. And my impression is that the international community even though the country has been isolated for its own sake for many years, I think that needs to support efforts in Argentina if they are serious. And because, as we have said in the case of Brazil, it is also clear that Argentina will need support most likely.
Okay, thank you very much. So the concerns for Argentina, concerns for the whole region include what will the US Fed do in terms of interest rates, and what's going on with China, the slowdown in China. So let's pick up on a couple of those points with a couple of our panelists as well. Carmen Reinhardt. The wisdom, and indeed the statement, talks about increases in US interest rates being small and gradual. What makes you so sure that that's how it's going to be?
Well, first of all, let me clarify that CLOF doesn't do forecasting of U.S. interest rates. This is basically this scenario that we are working with, what we view as probable. And let me highlight some domestic factors and some external factors why we think that a gradual interest rate rise, a gentle and gradual interest rate rise is more likely, and not a replay by any long shot of the 1980s. Just for those of you that are very young or younger than me, which is most of the audience, the late 1970s, US had double-digit inflation rates. So the historic rate hike associated with Paul Volcker in October of 1979 was coping with a 14% inflation rate. I would highlight that the current environment is one in which inflationary pressures in the US are extremely subdued. The decline in commodity prices and oil prices has contributed. The strengthening in the US dollar has contributed. And the fact is that despite a considerable tightening in US labor markets, there is no broad-based evidence of significant acceleration in wages. So both on the domestic considerations, i.e. labor market, and what we are importing via a stronger dollar and lower commodity prices, is there any kind of mandate by the Fed to really have to make a strong fight against inflation? I would add to that a new element here and now that was not a consideration when interest rate hikes took place in the 80s and in the 90s and in the 2000s is the fact that both the US public sector and the private sector remain highly leveraged. So interest rate spikes are potentially a lot riskier and would significantly increase debt servicing for both public and private sectors. On China, very briefly, I think I just want to highlight one brief point as regards contagion. In the past, if you looked at the Asian crises, the work that I did with Graciela Kaminsky, who is sitting in the first row here, and some years ago highlighted that Japanese banks were a common lender in Asia, and the fact that Japanese banks were adversely affected by the crisis in Thailand meant that they retrenched from other countries in the region, Korea, Indonesia, Malaysia. The new player in the current environment is China. And Chinese lending to Latin America increased significantly during the bonanza years, during the booming commodity prices, during the years in which investment in China was rising. And so the Chinese slowdown has two implications. One is, of course, what we're already seeing in through lower commodity prices, lower trade. But the potential exists that if something happens, say, in Brazil, and Chinese lenders decide they want to rebalance the same from other countries in the region, that is also a comparatively new factor in the contagion story that we didn't have during the tequila crisis of 94, 95 or earlier crises.
Actually, let's pick up on that point with Guillermo Perry, because China's appetite, especially for commodities, has been a boon for Latin American economies. As that appetite decreases, that's going to cause problems. So on balance, has the Chinese engagement with Latin American economies been good, been bad? How would you categorize it? And what's going to happen in years to come?
Well, many countries in the region in the last decade or so increased enormously their trade links to China. Was this a good decision? Of course, because China was growing much faster than any other country in the world, so exporting more to China, countries were able to grow faster. And even now, it's growing faster than most countries in the world. Now, let me compare this to the question if it was a good idea for Mexico to get in NAFTA with the US. Of course it was a good idea. It's the largest market. At the moment in which the US had a slowdown, it was not so good for Mexico. But in general, it has been a very positive move. Jacob Frenkel, former president of the Central Bank of Israel, once said that when Mexico was discussing if entering into NAFTA, told the Mexicans, listen, I know that one ex-president of Mexico, I believe Lázaro Cárdenas, said, poor Mexico, so far from God and so close to the US. And I can tell you, poor Israel, so close to God and so far from the US. So linking with big dynamic markets is always a good idea. Now, some countries did not take advantage of that as much as others, like my own country, Colombia. Still, we are highly dependent on China because we export oil and coal and other commodities. And even if we don't export them to China, when China slows down, the price of these commodities go down and we suffer. And when China was growing very fast, we benefited a lot. That's something we cannot avoid. What we can do is to diversify a little more our exports so we don't depend so much on commodity exports. That's a very different factor. And the last point, those countries that linked a lot financially with China were mostly Argentina, in order, Venezuela, Argentina, and Ecuador. Was it a good idea? Well, it depends. These countries were cut out from the international financial markets or had very limited access. So being able to get financial resources or investment from China helped them. On the other hand, it is true that China lending and investment policies are not as transparent as all of us would like and have a lot of tied elements, like the old aid in the West that had a lot of ties that were quite inconvenient. And now it's not very clear what's going to happen if China is going to refrain very abruptly to continue doing this lending and this investment.
Okay, panelists, thank you very much for the moment. Let's take this opportunity to introduce you all to the other members of the committee. Guys, I'm going to ask you just to stand up so people can actually see you and show yourselves off. There we go. Okay. Here, Pedro Carvalho de Mello, professor at ISAG's Business School, is that how you pronounce it, in Sao Paulo, former commissioner of the Brazilian Securities Commission. Next to him, we have Roque Fernandez, professor of economics at Universidad UCEMA, former minister of the economy in Argentina. Ernesto Talvi, director of Brookings Global Ceres Economic and Social Policy in Latin America Initiative, former chief economist from the Central Bank of Uruguay. Enrique Mendoza, our new member of the committee, presidential professor of economics and director of the Penn Institute for Economic Research at the University of Pennsylvania. And Laura Alfaro, striking a blow for gender balance, hooray, professor of business administration at the Harvard Business School and the former minister of planning and economic policy at Costa Rica. Love your country. Thank you very much. Great to have you all with you. Take a seat again. Yeah. I'm going to ask you guys to kind of weigh in a second. Let's wait for a second. Let's pick up the point with a couple of people. Ernesto, Liliana mentioned about the IMF helping Brazil break this vicious cycle of high fiscal deficits and high interest rates. But can you tell us a little bit more specifically how that might happen? Try it now. No, it's not there. It's not on that. It's just behind the scenes. Try it. Is it working? Okay, let's get to you another one. Tell you what, while we're doing that, is that one working? Let's hold on to that thought, shall we? Let's figure out the mics. Amanda, so let's figure those out, and we'll come back to that question. But we know that the microphones for the guys on the stage are working. So let's go back, actually. Let's pick up the question with Guillermo Calvo. You were talking about interest rates earlier, but I want to talk to you about exchange rates. We heard in the statement about flexible exchange rates that providing some kind of shock absorber, a buffer for Latin American countries against external shocks. But you're quite worried about the impact of those external shocks. Tell us a little bit about that. Why and what should be done?
Okay, I think we're going through, or we have gone through a period, very interesting period for Latin America, quite new in terms of Latin American history. We see countries in the region being not afraid of letting the exchange rate really take a big jump. And Brazil is the ultimate example in that respect, but it's not unique. In the past, we waited until reserves were down to zero, say, balance payment crisis, and at that point, the exchange rate was driven up by the market. Now, obviously, authorities have taken the lead. So, and accompanied by a very large piece of good news, which is the pass-through has not been very large. So the devaluation has taken place and inflation has accelerated a little bit, but not as much as comparable to the devaluation itself. So it's easy to conclude that floating exchange rate is finally, we found a solution to some of the problems that really were very hard to deal with in the 1980s. Now, I think the committee shares the view that I'm going to express now, and that is the fact that one has to be careful because having your own currency does not mean that now just by playing with the exchange rate, you'll be able to go forward under monetary stability. You have to work very hard. And actually, you may have to work much harder than under fixed exchange rates or pegged exchange rates, because under those conditions with pegging, you could stabilize the economy from a monetary perspective just on the basis of the credibility that you build by accumulating international reserves. That's questionable. But in any case, that gives you a backbone. Now, if you go floating and you say, well, from now on, that's going to be now our main, we are going to let the exchange rate move freely, the problem is that, I mean, you cannot avoid the problem of credibility, of expectations, of managing expectations going forward. So one risk, if one does not take that to heart in a real serious way, is that inflation will take its own dynamics and the monetary authority will have to follow through. That was the problem of the 80s. So be careful. Now the region is not as much dollarized as before. The region has more reserves, so there's a bit of a backbone. Some countries, not Argentina, apparently is going to go flat at the end of this administration from that point of view. But now the region faces a responsibility that has to find some anchor. And the feeling that some of us in the committee have is that the anchor has to be fiscal. We are going back to fiscal. I mean, without a fiscal anchor, and we know that some of the key countries we've been talking about, Brazil has a big fiscal problem, Colombia has a fiscal problem, Argentina obviously has a fiscal problem. Thinking how the region is going to operate in the future to the extent that they are going to rely more on floating exchange rate, and that's good news, gives you another variable that can take the brunt of the adjustment, but you cannot drop the responsibility of guiding future expectations. And we have, and with this I end, the possibility of going back to the 80s. And Brazil is another good example. In Brazil, the debt was very highly indexed in the 1980s. Still today, a large share of the debt in Brazil, public debt, is indexed either to the price level or the exchange rate, so that it's true you have a floating exchange rate, but it's not 100%. It's not the US situation. Now you have interest rate reacting to what's going to happen to the exchange rate, and then you can fall very easily into a trap that if you don't really control expectations, because people feel that the fiscal is out of whack, for example, and they start expecting higher inflation, interest rates will be high, and the point that Pablo made before, had been made before here in this committee, that fits into the fiscal deficit, and consequently you can fall into a trap of high inflation, high fiscal deficit, etc. And this is not fiction. This is what happened in the 80s. So that's the concern, and countries should be aware that they had to find a strong anchor. I think from the country point of view, domestic policy, the strong anchor has to be found in fiscal, and you can find, given the fiscal anchor, it's going to be easier to find institutions like the IMF, the World Bank, etc., that come and offer further support, perhaps in the transition. But without the fiscal floating exchange rates, I don't see much of a good future.
Thank you. And that leads us very neatly onto Ernesto Talvi to talk about how the IMF might help an economy like Brazil. Is that microphone on now? Yeah. Great.
I think it coordinated much better this answer with Guillermo's response right now, as you said.
All planned. All planned.
Fully planned. Look, we've come to stigmatize the IMF, but the committee believes it's a rather useful institution, and the times at which you want to use an institution as the IMF are the times in which either you lost access to international capital markets, or you can only access at prohibitively high interest rates. That's the time when you usually resort to the IMF in order to try to put your house in order, get back to your feet, regain creditworthiness, credibility, and therefore access to international capital markets at reasonable rates. And we believe that the situation in which Brazil is today is not going to be easily resolved without the support of the international community or the IMF, because it is trapped, as Guillermo was just saying, in a vicious circle in which very high interest rates are eating up and making the deficit balloon. And there's no amount of primary surplus adjustment that will buy you immediate credibility to really decrease the interest rate bill, which is really killing Brazil. So essentially what an agreement with the IMF would buy for Brazil is that first it would be a fiscal adjustment, would be somehow have the seal of approval of the international community. That in and on itself would be a credibility enhancing device. Second, that the IMF usually puts the money where their mouth is, so they will come up with resources at reasonable rates in order to bridge the gap between the time in which Brazil will need to finance its deficits through IMF resources and the time in which it regains the credit worthiness to go back to market. So all this, and with this I finish, requires obviously that the political, that you have the ability to govern. And in fact, what happened in Brazil is that we were entering the operating room to do major surgery, and suddenly we lost a surgeon. So it is a prerequisite that the political situation stabilizes in Brazil.
Interesting point. Why don't you pass the microphone to Roque Fernandez, who's sitting next to you, the former Minister for the Economy from Argentina, talking about political stability. Give us your take on the election in Argentina. Is it going to mean an end to this populism?
Well, this is a question that changed a little bit of the subject from monetary theory, fiscal theory, exchange rate theory to political economy. And I believe that the problem that we have in Argentina today is something that gives us some sort of expectation, because populism is confronting to a different coalition that are a coalition of Republicans or Democratic parties in Argentina. I think that what we have learned in the last time in the area in South America, including Venezuela and Argentina, that are, and maybe Ecuador, those are regimes that they have a lot of populism, is that populism cannot be characterized in the same way that traditionally you look in the United States or in Europe, thinking in terms of the left or the right. So populism can be from the left or can be from the right. The competition, the political competition, is populism against democracy, in the sense that if populists impose or they win in the ballots, what happens is that they will try to modify the democratic system. So they will go through a process of eliminating the division of power, the independence of justice, the freedom of the press. That is what we have seen in Venezuela and what we have seen in Argentina. Fortunately, in Argentina, they were not successful. And so what we have today is we will get a result next Sunday where I believe that populism will lose in the polls, and it is a great expectation that this new coalition is going to be able to introduce democracy in the long run of Argentina, but this is pure expectation.
Okay, interesting. We will wait to see. Please pass the mic to Enrique Mendoza, our new member of the committee. Tell us about Mexico's economy. How do you expect it to perform in the near future, in the light of the challenges that are affecting the entire region?
Very good. So it's important, given that we've been talking so much about doom and gloom in the southern cone, that the perspective from Mexico is in some ways quite different, and the contrast with the situation in the 1980s is also quite different. So Mexico started in the 1980s being run by a semi-socialist government who was into owning hotels and bottling companies and airlines, and very large government that had borrowed a lot. There was a lot of debt in the private sector as well. There were no reserves. There was a managed exchange rate. And the explosion of the declining commodity prices and the increase in the interest rates that Carmen Reyna was talking about basically sank the country into what was the onset of the lost decade. What we have right now is a situation in which the financial management of the economy has improved significantly. So the country has much lower debt levels. since 1994, after the collapse with the peso crisis in 94, the management of credit policy has also been much better. So during the recent credit boom in many emerging economies, credit levels in Mexico have risen relatively much more modestly. That is not to say that the country does not have problems, serious structural problems, in which structural reforms have lagged behind and been very slow to progress. And the few ones that we have managed to make, like the oil reform, came at a bad time in which the decline in the oil prices made investments into Mexico's oil industry much less desirable than they were ex ante. So there have been some changes in other areas of the economy that have been much more modest. In the educational reform, the government has run into very serious problems. And tax reform basically was severely diluted and is not likely to progress much. But in many of these big questions that we've been raising in the context of Brazil or in the context of Argentina, the Mexican economy looks much different, has become much more integrated with the United States, as Guillermo Perry was mentioning. So our fortunes are now much more linked to the fortunes of the United States. Fiscally, the country remains highly dependent on what happens with oil prices. And that is why the tax reform was so important, and why the fact that it didn't do so well is a shortcoming.
Okay, thanks. Why don't you pass the microphone to Laura? You talked about a slightly brighter picture. In Central America, countries there have benefited from a kind of positive terms of trade shock. How sure are you that that region can escape this potential contagion that might be affecting other economies in South America?
Thank you. First, you have become my favorite person, not only because...
okay, you don't need to say any more, actually.
Yeah, say nice things about Costa Rica, but also questions about Central America. So in the committee, we joke a little bit, because we have the Equatorian divide, us in the north.
Please stand if more
and the ones in the south. Because as Enrique and Guillermo said, we still are more linked to the U.S., and so this geography linked to the U.S. has meant that countries in Central America are benefiting from exporting to the U.S., but also remittances, which are an important part of many of the countries in the region, have increased. But also for political reasons, the region doesn't have as strong ties with China. So of the region, only Costa Rica recognizes China. Increasingly is getting in, and people have heard of the famous canal China wants to build in Nicaragua. It's very unclear if it will happen. But the relation is not as deep. And also because of geographical reasons, we don't have oil. So we are not linked to China, neither directly or indirectly. So we're actually now benefiting from very positive terms of trade. And so if you look at estimates of growth, the region is the Central American region, and we tend to include Dominican Republic there. You may want to talk to the IMF that class of geography that they missed, but fine. These are some of the countries that are growing the most in the region. So you see Panama growing close to 8%, Dominican Republic 7%, and again, because of this positive one relation. The potential of an increase in the US interest rate has the ability to, again, unsettle these countries, because equally some structural reforms were never taken, and fiscally some of these countries have still a lot to do. And it just so happens that these are countries with very low tax bases. So people tend to complain about the huge tax burden in the US. In Brazil, that is close to 40% of GDP. Guatemala is 10% of GDP. So they're dealing with, if you want, very different structural issues, but at least externally, a little bit more positive.
Great, thank you very much. Very interesting. Let's open it up to some questions from the audience. Oh, great, some hands going up. I'll take one or two, and then what I'd like you to do, the microphones will come round. I'd like you just to stand up, say who you are, where you're from, and then please limit it to your question rather than a statement on your own behalf, as we don't have a great deal of time. We'd like to get to some questions. Let's start with, this second row has 3 questions, I think. The two ladies here and then the man at the end.
Good morning. Thank you very much for your comments. I'm Monica Debole with the Peterson Institute. I'm also a Brazilian, so I have a lot of thoughts and comments to share on Brazil. First, let me say that I do agree with the general diagnosis that my country is suffering from a kind of fiscal dominance, which I think is where the panel is coming from on this issue. One thing that is striking, though, with respect to where Brazil is now compared to where it was in the 80s, is that obviously the amounts of, the borrowing needs are high. Debt ratios are high, but it is all locally denominated debt. So in many respects, the kind of dynamics that appear to be taking hold in Brazil, particularly in light of the current political dysfunction that is dominating the country. And here I would say that the surgeon is still in the room. It's just that his hands are tied. But the surgeon is there. The minister is there. He's still trying to fight for his fiscal adjustment. It's unlikely that he'll get it in the current conditions. But the one thing that seems a danger to me, and I think Professor Calvo alluded to it, is the danger of, or the risk of having runaway inflation in the country again. The country's in recession. It's a very deep recession. Inflation is not abating despite the high levels of inflation. So this is just like the sort of thing we used to see in the 80s. Reindexation is back with a vengeance in Brazil. And unless we do get these nominal anchors in place, this seems to be where we're headed. And I don't see how the IMF comes into that equation. I'll leave those comments to Teresa to say something about.
Okay, is there a question coming, Monica?
The question is, what is your impression? I mean, does really the IMF have a role? Because it seems to me that the overall effect of all this is just higher inflation unless there's a proper fiscal anchor put in place. Thank you.
Okay, let's get another question first, then we'll get that one answered.
Well, actually, mine is not a question. It's also a comment.
Okay,
So
well, would you mind if we got a
your
question from this gentleman first? Is yours a question, sir? Yeah. Great.
Okay. Thank you. I'm a research intern in Brookings. My name is Tal. I'm glad I see all of those people I respect very much, actually. My question is linked to the China's part. I think two differences. At least I think China's investment in Latin America has two differences. One is that I think until now it takes the major form of the foreign FDI, part of the bank lending, but by the state-owned banks and the development institutions. I'm wondering whether you think that can be different in terms of how we understand these dynamics. Because to me, to a Chinese citizen, actually, we think our government and our state-owned banks are too generous in sometimes.
That's an interesting point. Actually, let's get a couple of responses to that. Roque Fernandez, you look like you were ready to respond to that. Yes or no? No. Okay. Which Guillermo? We have two.
No, that one.
Okay, Guillermo Perry. Well, let's get you to respond to that first question. About
the Chinese question.
You want to respond to that one?
Yes.
Okay.
Yes. No, there is a lot of foreign direct investment, mostly on the commodity sector. And I think that has been positive, as I said. But of course, now that the prices of commodities are down, it's likely that this investment is going to slow down. But there's a lot of lending also to two countries, especially, which are Venezuela and Ecuador, that didn't have access to capital markets. So there is also a lot of lending there. I might just mention that for most of our countries in the past, when we have had difficulties of the type that Brazil is experiencing now, accessing the fund has been important, not only to facilitate political internal agreements to do the fiscal adjustment, because now there is a bonus to doing that you get resources from the IMF, you get a seal of approval, and then you may lower your interest rate for accessing the market. So in that sense, going to a fund, if the government of Brazil wants to go, which is the main question. That is the key question.
May I suggest something? For the first question, which we're kind of going back to Brazil, can I suggest a couple of comments from both Guillermo Calvo and Ernesto Talvi?
Sure. I think Laura just wanted to come in.
Sure. After
let's get you a microphone. Just behind you.
And this is just a little comment. It is true that a lot was FDI, but I would be careful because, again, the comment we made on lack of transparency, most of these contracts are not very transparent, at least the ones that I've seen. They have a lot of debt type little things in the contract, which should have been an equity type contract. So there's very little, so things should be more contingent. And also, many of these contracts are tied to you need to import goods from China, capital goods from China, the labor from China. So I want to see now that the tide went down, we're going to see a lot of these little clauses exploding here and there. We're going to find out that it was more like debt and less than equity that we thought. But again, the real problem is the lack of transparency in all of these transactions.
Okay, let's go back to that first question then. Is there really a role for the IMF?
I want to say something.
You want to talk about China as well?
Yes.
Okay.
No, because I agree with what Laura just said. Laura. Sorry. But I want to actually point out on the same issue of transparency that in the case of Argentina, China has played a significant role as regards to swaps to the Argentine Central Bank, where now it is suspected that Argentina will essentially have zero net reserves when the government changes. And half of what are gross reserves are now in swaps with China, where contracts have not been disclosed, where it is not clear whether these are simply short-term loans or they are collateralized with existing reserves, namely just simply window dressing operations. And I think that is a point where also I think that institutions like the IMF should be very careful when countries contribute to lack of transparency in an explicit matter, in which, of course, in the case of Argentina, is compounded by the lack of transparency of the Argentine government. But these swaps with China are not the only instances where there has been lack of transparency. In the case of Argentina, there have been also swaps with the Banque de France, which have not been disclosed, and the BIS has, during all these years, contributed to the sheltering of assets of Argentina, trying to escape essentially rulings in courts for their defaulted bonds. So I think that all of these practices, which are not necessarily relate only to countries, but also to advanced economies and to institutions like the BIS, are all contributing to a significant opaqueness in net reserve positions of countries.
Okay. Before we go back to the IMF question, let's just see if there's any more questions in the audience. And we've had a couple of comments on the IMF issue. Let's get something else from this gentleman here. Nice to see you again.
It's John Hicklin. I was for many years at the IMF. I was very struck by the comment, which has just been referred to again by Pablo Girotti, about the reserve position and how it's very untransparent these days. Now, you know, one of the IMF's role years ago, after the previous set of crises, was to help to coordinate better definitions of reserves. Very difficult negotiations with the G10 central banks. The IMF board agreed it, and a new process was put up for a reserve template. So what is wrong? Is the definition inadequate and needs to be revised? Is it being gamed by the central banks with collusion from others? Or is the IMF failing to do the monitoring and dissemination and analysis that's required that would help markets make good decisions? So what's wrong and what can be done about it?
So when I said we weren't going to talk about the IMF, actually we are. That's okay. Carmen.
So opaqueness comes in different forms right now. These three varieties don't tend to be seen as very important in good times. That is when the trend was towards reserve accumulation, but they become all important when things turn bad and reserve accumulation becomes reserve losses. Number one thing that is very difficult to track is central bank intervention or induced central bank intervention via third parties. In other words, it's not the central bank is not directly showing a loss of reserves, but it is inducing other institutions to do its bidding. Namely, it could be state-owned enterprises, it could be sovereign wealth funds, it could be the local banks. And this practice is not limited to Latin America. This is going on in varying degrees in the oil producers, in Asia, in Latin America. It's an issue. Second, there's the issue of, which Liliana already mentioned, gross versus net reserves. Brazil, Indonesia have been two countries that at various points have issued dollar-linked debt. And this is central bank debt, so this is not showing up either in the government balance sheet, and often because we focus on gross reserves, is not appropriately netted out. Number three, there is the old issue which the IMF valiantly tried to tackle after the disaster with Thailand, that, you know, we all thought Thailand had about roughly 31 billion of reserves, and it was closer to 2 because of derivative positions. And Pablo mentioned already that, for example, Argentina and Brazil do have swap lines. And getting concrete standing on what the magnitudes and the profile of those swap lines and so on, to highlight an example, is difficult. So derivatives are still an issue. I mean, there is, I think the IMF's template in coffer moved in that direction, but we're really far from addressing these other issues.
Okay, let's go to that gentleman over there, had his hand up.
Guillermo Alborta, I am an independent economic consultant. If this is the case, and we still certainly mentioned two scenarios, kind of lacking on transparency in both, I would say, and the recursive question is, which one will be the anchor, the monetary policy or the fiscal discipline? I think different countries, different realities show that the countries will pick what really creates a good image for them to really adjust their economies and to create a very good image to say, my policy will work. And the region is spread it up all over with totally different realities. We are not able to conclude that, let's say, let's solve Brazil and the region will be benefited. I don't think so. Let me disagree in that regard to say, let's first resolve Brazil and we will really get the benefits of what will be good in Brazil, taking especially into account these different realities, especially monetary issues, fiscal issues.
Liana.
Yes, I don't think that we said that solving the Brazilian situation would immediately solve the problems of the region. What we said, and also we did not say do one first and then the rest will follow. What we said is that the core of the statement has been focused on contagion. And most of the time in the past, we were talking about contagion coming from advanced economies. Now we're finding sources of contagion within the same region. And we have identified Brazil as the most important source of contagion for the other countries in the region. Of course, and different people have given different answers regarding the situation in their own countries. Of course, every country has different issues, and they will have to be dealing with them to be consistent with the stability of their own economies. You know, it's not as if you choose having good fiscal or good monetary. You certainly need both. But it could be a situation in which you believe that, okay, if I have the monetary anchor, then I'm out of the woods, and I don't have to have a fiscal anchor. Our stress in the statement has been for having a good fiscal, a good monetary anchor, you also need a fiscal anchor. That has been the bottom line of the statement. I won't take more time.
Please, I was actually going to ask you to give some kind of closing remarks. You feel like you're doing
I
it
would
there, so why
love
don't you
to
finish
have,
your
can
point?
I take the time of the audience, just 1 minute, to allow the answers for the IMF question, because we debated so much on that I would really like Guillermo to have a word, and then Ernesto Talvi to please explain on that. I would really love to
Adelante.
have. Please. Adelante. Guillermo.
Well, I was hoping
Not to.
not to.
The time will run out.
Yes. It's a very difficult question. I mean, it has a political side that was mentioned. So if Brazil doesn't want to go, there's nothing we can do. The question is, what kind of fund do we have? At one point, I equipped that the fund doesn't have funds. Because if you have a lot of funds, which is what happens in Europe with Draghi, Draghi, what he did was to state that he would go to extremes to guarantee that the sovereigns in the region would have finance, and that announcement and the credibility of the announcement was enough to lower interest rates in Italy and other places right away. Now, if we had an institution that could provide that service, and Brazil was willing to take the services and the commitments implied with that, then certainly the Brazilian problem is not insolvable. In fact, it's a very easy problem. It's difficult adjusting the primary, adjusting the rest, which depends very much on expectations. Just control expectations. How could you do that? Say, give me all of your debt, I'll give you something in exchange, which has full credibility by the Fed, say, or the fund, if they had the funds, and the willingness to do it, which I think that's not in the cards, then Brazil would have a good chance. Now, without that, they get the stigma of going to the fund, they get the political whiplash domestically, and it could be counterproductive, despite the possible benefits that Guillermo the Young has emphasized.
And let's get a point from Ernesto, and then we'll probably wrap up.
Yeah.
I think you made very, very good and interesting points. Just let me take a little bit of issue with the fact that I'm not thinking about Joaquim as a surgeon. I'm thinking about Dilma, because there's nothing a Minister of Finance can do if you don't have the support of the political system. But let's assume that we have a surgeon. And then you have two possibilities. Try to go on your own and produce a credible primary adjustment, hoping that interest rates will come down so you are not biting the tail of the dog, and therefore the interest rates killing you. If credibility is not immediately forthcoming, then I think your scenario becomes realistic. I mean, ex post, and Guillermo has this beautiful paper of 1980. I don't know when did you write it, Guillermo, but we all learned it in your classes. Ex post, Brazil would have to resort to high inflation in order to make real interest rates exposed low and probably collect some revenue from inflation tax, which actually it is now better prepared to collect because, as you said, now there's a lot of nominal debt out there. So unless you think that you're going to bring in credibility immediately, then we do not yet have a Draghi, we do not have a central bank, but the IMF is as the closest you can get to getting something of the sort. Bringing the IMF, do a credible program that has the state of approval of the IMF, and bringing the resources of the IMF at reasonable rates to bridge the period in which you have to earn the credibility to regain your creditworthiness and go back to the markets. It might not work, but we think at this point the only thing that really has a chance to work.
Okay, ladies and gentlemen, if you'd like to stay, I'm sure some of the committee members are going to stick around. You can maybe have longer conversations with them. But I'd like to thank you, and I'd like to thank the CLAF committee for being here this morning after a long weekend of working. Thank you.